IKONINI.
Episode 259. Tukisema like, subscribe, hit the notification button, tell a friend to tell a friend, sindio?
Yeah,
na vile mwambiaga jo mwaga niko kwa internet na forage and I forage for information na kaa kuna msee moja nilifindigi super interesting ni msee tuko na yeye saizi yeye mostly obongaga juu ya financial literacy na pia unaweza consult na yeye even on a personal level about financial literacy msee mwenyewe na bonga juu yake anaitwa Steve KAHOME. Because mostly the first time niki bonga juu yako I think niko naambia either rap naambia kuna msee fulani juu anaitwa Wahome wakamkali nini kaka nika notice ni K. Yeah. Niaje Steve?
Niko poa sana.
Yeah. Kwa hii industry ya history ya financial literacy ulijipatagaje?
Nasema ilianza tu kama like an interest that I had picked.
Yeah.
So I was just looking for information about how I can start investing.
Okay.
Just trying to learn about financial markets.
Okay.
So tulizanga tuka group na wase tukajichallenge, okay, let's try and learn this thing.
Yeah.
And whatever information you can gather from any sources you can share with us, then we can discuss.
Okay.
Then after a few weeks nikajipata nikani mimi peke yangu na contribute kwa hii discussion. Alafu wase nikawa contribute sana.
Yeah.
So I was like why can't we live in a closed group and I can just share my thoughts in the internet or what I've learned in the internet and even other guys can come to the conversation and contribute. You know, one day even if you are wrong about something on the internet, the guys will come and say, okay, it's not like that, it's this way. Yeah. So in an open forum, like maybe in social media, maybe on Twitter, there are guys who are willing to jump on the conversation and keep the conversation going. Yeah. So that's how I started. That's something that I was picking an interest on.
Okay.
Yeah. Then I don't know if it's by coincidence or by luck. I came to maybe learn about a lot of things because I was trying to learn about all angles of the financial markets, about financial literacy. Yeah. Then after some time, I even discovered that, okay, this is maybe a career that I can even start a career in finance. So I started looking, okay, what certifications can I take? How can I be a certified maybe financial advisor? How can I work with companies? How can I work with asset management companies to help people to manage their wealth and also learn more about financial literacy?
Okay.
Yeah.
So like where did you get your certification?
Okay, so far I've done CC. It's a Chartered Institute of Securities Investment.
Okay.
And I'm also planning to do my CFA and become a charter holder.
Okay. Yeah. And like why was that interest there? Because I feel like financial literacy is one of those things where we all think we are financially literate. Si tunajua mimi najua do, tunanifunza nini juu ya do. But a lot of us are financially literate. Like tukipata do kidogo ni vile tu lazima ile nini ya meja ni lazima inakuwa lazima nitawashow
lazima utatesa lazima ajue
lazima wajue that's such kwa financial literacy ni lazima wajue as long as I'm doing well haijalishi si nimemove out nilikuwa naishi ghetto saizi naishi Lavington unaona na kupigia picha nikienda kwa club na kupigia receipt I'm doing well, that means I'm financially literate. So why did you feel like people need more information?
Okay, first, unajua ukisoma sana there are a lot of things that you tend to think differently from most people if you're exposed to some information or maybe to some level of knowledge that is not maybe the conventional knowledge. So like I think coming from that background of maybe reading a lot and maybe just doing my own research, I came to find, okay, these guys are doing this way, but I don't think it's supposed to be that way. You know, so when you learn about something and you come across maybe a topic like real estate or maybe land investing, and you just try and ask yourself, why are these guys, why is everyone talking about land? Then you try to think from first principles and you come and realize that these guys are just not maybe whatever they're trying to get from land is just something that has been injected in them maybe from upbringing or maybe from our parents, but it's not something that makes even a lot of financial sense. Yeah.
Okay. Because one of the things, kabla even to dig deep, one of the things that I like about when you're writing about finances, kuna kuagana this one thing that you always put at the end, enjoy your money. Because I think like sometimes we forget that. Life tomorrow is not guaranteed, so of course enjoy your money. But now I think even before tuingia kabisa, I'd want to look at it this way. A young person who's starting out, salary around 30,000 shillings, is there room for investment?
I think there is. Okay, but there's always one thing that I've always, I think there's like the most powerful powerful thing, or maybe the most powerful factor that I've always thought about when it comes to investing for young people is that the most important investment you can make is investing in yourself. Because if you look at the lifespan of a young person, if you are in your 20s, you're just getting started with your career, right? So there's a very huge chance that your earning potential will increase with time. If you look at the careers of most people, what you're earning in your 20s is not what you'll be earning in your 40s or maybe in your 50s. You will scale the career ladder. You'll get more experienced. You'll maybe upgrade, maybe further your studies. So automatically you are more likely to command a higher income as you age. So I think that's the most important thing that as young people we should realize, that the biggest investment that you can make is investing in ourselves. That we should always look for ways that you can increase our earning potential. Whether it's furthering our studies, learning an extra skill, whether it's getting that job experience or maybe the required experience for you maybe to maybe command that higher income. But regardless of any amount that you have, I think if you have, there's always some level of investment that you can make. Whether it's 30,000, whether it's 40,000, 10,000, and also that the habit of cultivating the habit of saving money and investing money from just whatever little that you have. I think it will be very much easier to carry forward that, because if you are managing, if you can be trusted with little, then you can be trusted with much. That's a Bible verse.
And so Nini, because I think like one of the main things that young Kenyans do, and this is to show that we are successful, is buying a car. And by that I mean, like in my 20s, as soon as I made some little money, niliend up na gari. I think at some point I had 3 cars, which is very stupid. 2 as an investment, but then I came to find out cars are not the best form of investment. But history ya gari, do you feel like there's a cure to it? Because I feel like Kenyans who feel kama sina gari, I'm not successful. What do you think, Ama? What do you feel about that?
I think it depends with how you look at it, and also your level of wealth and also your financial goals. Because I think there's some, depending on how much you spend, maybe whatever amount.
Nabonga jua Kenya wana make 100k kwenda chini. Yes. Net. Let me even put it at net. 100,000 net kwenda chini. You'll find we are just obsessed na gari. Like tuna feel like nikishow up hapa na cab watu watachukua sina heshima. Nikishow up hapa na matri hapo watu watanisikiza. Nikishow up na ndudhi nitafukuzwa. So
so I think one thing comes from a bit of financial illiteracy, because if you look at most people who take car loans, watu wengi wakuangi wameangalia the other factors that come with car loans. Because if you're talking about 100k net, that's the gross, that you talked about it, not gross, 100k net. Yes, if you are maybe in your advanced years, maybe you have accumulated a little bit of wealth, so maybe you can maybe save up cash, maybe buy your car cash. But if you're talking about most people maybe who have maybe just started their careers, don't have a lot of savings and investments, so most guys are going to be buying their cars through car financing, maybe taking a loan or something like that. So I think one of the things that most people never consider when taking loans to buy cars is the extra cost, maybe the hidden cost that comes with purchasing a car. Because you have gotten a car, maybe a car loan to buy a car. So one thing you have to notice is that you'll be paying your car loan. That's the first expense. The second expense is fuel expenses. You have servicing and maintenance. Another hidden cost like parking fees. Maybe you can see nowadays we have it here. Where you're using the expressway, you have to pay some charges. There are a lot of hidden costs. With a car you can get an emergency anytime. Maybe someone has hit your side mirror. So if you can accumulate, or if you can bring up all those expenses that come maybe from car financing, maybe owning a car from a loan, I think if you do the maths, for most people it will not add up. And that's why you'll see that most people, yes, you have a car, but maybe you don't use it as often because your budget is overstretched. And then also if anything happened, maybe you lost your job, maybe you lost your secondary source of income, then that means maybe your car may be auctioned by the bank, or maybe to maybe repossessed by the bank because now you are unable to pay for your loan. And I think also the other thing that you have talked about is that we want to live large, we want to show people how much money we have. I think there there's a quote whereby Morgan Housel, who is the writer, the author of the Psychology of Money, where he says that the singer Rihanna once sued a financial advisor, and then the financial advisor told him that, you know, that when you buy things, you'll end up with the things, but not your money.
Okay.
Yeah, so I think that
funny trade, eh?
I think that's what applies, because there's the accumulation of savings, so income not spent. So if you end up using if you end up buying things, you'll end up with the things,
but not the money.
Yeah.
Okay. And a lot of us want to have our cake and eat it, eh?
And then also I think also on that part, Morgan also says that most people get the wrong idea of what it means to become a millionaire. Because most people assume that being a millionaire is spending $1 million, but it's actually the opposite. It's saving $1 million.
And still living. Ile million ni kama iko untouched.
It's not about spending the $1 million. It's about saving the $1 million. Yeah. So I think there's also that.
Ila tukiconvert in Kenyan shillings ni that's $60,000, eh?
You're a 60,000 spend.
Tuko uko mbali sana na nini. So nataka tu bonge juu ya vitu kadhaa, zile bonga juu yake. You like talking about investing, eh? And but normally I look at maybe the things you talk about and I'm like, kisi vitu, how does just a normal Kenyan just decide, you know, let me invest in this? Because let's get this out of the way. The number one way of investing Kenya inakuaga land, real estate. I think there's even a famous saying in Kenya, you can never go wrong with real estate. How true is that statement?
I think it's very untrue. If you ask how many people right now have pieces of land and they're looking to sell them and they actually can't get buyers, you'll find quite a few. Then if you also ask how many people bought land are now dealing with court cases, you'll find quite a lot of people. And then if you look around and find how many land scandals and scams have been there in the country in the last maybe few years, there are quite many. So I think the idea about investing in land maybe has been carried forward from our parents, because I think, you know, investing in land is easy because you can see the land. It's something tangible. You have your title deed. You can tell people, okay, I own this piece of land. It's 50 by 100 in Kamulu, Joska. It's something tangible. But now if you tell someone that, okay, I invest maybe my money in a money market fund, maybe I own stocks, you know, the only tangible thing you have, maybe it's your brokerage account. Maybe you can open and show guys, okay, I own Apple, maybe I own Safaricom, I own this number of shares of this. So it's not something tangible. It's not something that most people have not been taught. That's where now financial literacy comes in. So we have been raised up knowing that, okay, land is and real estate is one of the major investments. And also if you look at our media, radio stations and our TV stations, a lot of adverts are about land. Just listen to your local radio station, and after every few minutes there's an advert about land in some place. So I think people are fed about this idea about land, real estate. And if you look at the other ideas of maybe investing in the stock market, in money market funds, interest bonds, it's not in the public domain or maybe in the public media as often as we see the other adverts on land and real estate.
Alafu the question then would be like, okay, there's another thing I always say, that with a certain level of wealth, even renting is not a bad thing. But what do you think about rent? Is rent always bad? Because musikiaga watu wakisema, bado nalipa rent, nuko na doka hiyo, mimi siwezi lipa rent kani kwa doka hiyo. Is rent that bad?
Okay, I think it depends from your personal perspective, because you know, personal finance is very personal. You know, there's something that maybe we can all afford, but maybe I may not want it as much as you do. Maybe it's not a priority for me. I think that's one of the things that I always advocate for, which is conscious spending, which is an idea that was written by Ramit Sethi in his book. So he talks about that. You know, he had a friend who got a promotion and he moved out to a smaller apartment. Because for him, he says that, you know, going biking and hiking was more important for him. So for him, when he got the promotion, he wanted to have more money to spend in his outdoor activities. And he did, and he realized that maybe his rent was eating much of his income, and he wanted to save more for his hiking activities and still live within his budget. So that's what we call that's maybe one example, but again, like I said, personal finance is very personal.
Yeah.
Even if we have the same level of wealth, or maybe different levels of wealth, there's what's more important to you, and there's what's more important to me, and we'll always be different. You have different opinions, you have different perspectives about life, you have different tastes and preferences. So I think that's different. But from a financial literacy point of view, maybe from a financial analysis point of view, I can say that if you have maybe you have cash here and you want maybe to spend in buying a house cash, there are a lot of options that maybe will be more financially literate than maybe buying the house cash. Because let's assume you're buying, this is just an assumption, you want to buy a house that maybe worth maybe $1 million. Let's just use basic math that will be easier to do the calculations with.
Yes.
Yeah, so you have a few options. So it's either you can buy the house in cash, you spend your $1 million, and the next day you don't have it, but you have the house. Then the other thing is that you can invest the money maybe in any investment asset class. Maybe you can talk about treasury bonds that are fetching quite high returns right now, returns of more than 18%. Yeah. So basic math, I think that will come to around 180,000 per year. So twice per year you have your 95,000. So and you still have your 1 million with you. Yeah. So you can decide, okay, me I don't want to own the house. I still want to live off my investments. Maybe I want to still have my cash. And with your cash, if you can maybe accumulate more cash, maybe add to the 1 million, you can still get to a point whereby you can maybe even meet your expenses of your returns from your investments. So I think mathematically, or maybe from a financial point of view, it's possible to make the decision that, okay, I'm okay with renting, I don't have to own a home, maybe a house, because okay, this doesn't add up for me. But past a certain level of wealth, there are people who don't just care about, okay, not that they don't care, but they're not concerned. You know how maybe let's say today maybe someone borrowed you 1,000 and you just lend them. Maybe you'll feel a pinch of, hey, I've just lent that guy 1,000, but maybe another person's level, maybe it's 100,000. Someone asked me for 100,000, I give them, okay, I'll feel a pinch, okay, hey, I just lost 100,000. But maybe past a certain level of wealth, you can afford anything. You can afford to splash money on anything. So even if you went and bought a house, you are still not a huge percentage of what of your wealth. So it still doesn't concern you that much.
Okay. Because so wewe tuseme unatembea pahali uone a rental apartment and you see someone with a Range Rover, what do you think? Do you think they don't know what they're doing?
No.
Like what comes to mind? Let's say you don't know nothing about them, but when umso renti keja na drive range.
So I think there's obviously the conventional wisdom, or maybe what we call status symbols, or people, we are human beings, we're always chasing status, and we're always playing status games. There's how we want other people to see us. There's how we want to appear in public spaces. So maybe the common person, speaking from the layman's terms, maybe from the common person's understanding, he may think that decision is very stupid. But maybe in the back of the mind of that guy, maybe he has made several investments that he's able to maintain his lifestyle well, and maybe even he's paying off the rent of that house from the returns of investments that he has made. And also maybe he has some financial understanding that he has organized his life in a certain way that we cannot understand from an outsider's point of view. Okay. So there's this Nini, like I was saying, there's this thread you did about financial investments, and I remember you said that the best one is the money market fund, MMF. You put it as number one. I don't know if you put them in orders, but ukona sema it's low risk. So yes, let's start with that. MMF, ni money market fund. Yes. Why is it a good investment? Okay, maybe just a point of correction. First of all, okay, it's not the number one investment, but I think it's the starting level. It's like the baby class of investing. Maybe the PP1 of investing.
The PP1.
It's like the first step of investing. So the first step to investing is saving. Okay, it's earning money and saving money, because you cannot invest money that you have not saved. Because savings is the difference between your income and expenditure. So the first step is savings. And if you look at how people save money, or how the common person goes about savings, most people just save their money in bank accounts. But your money is earning there are some bank accounts that even will give you maybe 1%, less than 3% per annum, which is very low because these banks are using your deposits to lend money to businesses and to other individuals. And right now, the lending rates are as high as 16, 17, 21%.
Oh, okay.
So you can imagine these banks are making 21%, they're giving maybe 3% or less, which is very unfair. Because if you knew better, you could do better. So the basic of a money market fund is just like a saving account. So it's just a pooled, so maybe just to explain what a money market fund is, it's just a pooled investment firm, or maybe what you call a mutual fund, whereby different investors bring their money together and then they give that money to a fund manager. Then the fund manager is this professional who looks at what asset classes can invest in this money so that they can give the investors a return. And now in the case of money market fund, this fund manager, as regulated by CMA, has to invest in low risk avenues. This include treasury bills, treasury bonds. We also have fixed deposits, call deposits, demand deposits, such kind of investments. And the good thing now about a money market fund is that your savings will get a decent return on investment. Because right now money market funds are giving maybe from 12 to 16%. Compared that to your 3%. That's a huge difference. The first step to investing is to beat the inflation rate. So inflation rate in Kenya it's between 5%, 7.5%. So your savings account, there's no way to ever beat the inflation rate. But now with the money market fund, you are doing it very easily. It's very low risk. You can easily access your money within 2 days of asking. So I think it's the first step to investing. You have to accumulate your savings in a decent place.
But sasa swali ni hii money market fund naipata wapi? Saa hiyo ndio swali watu hujiuliza. I think Safaricom has Mali. Is it Mali?
Safaricom has Mali, which has I'm not sure if there's a time when they launched, they were accepting investors up to a certain level, then they what do you call it, then they stopped accepting new investors, but I'm not sure if they have resumed. But we have quite a couple of options. I think we have 25 fund managers in the country right now, and they're all offering money market funds. 25 fund managers, and they're all offering money market funds.
Ni kama gani na mtu anazipataje kwa phone? Kwa hiyo ndio kitu niko sure sasa niuliza.
So
unapataje kwa simu?
So maybe there are some like CIC, which is the largest unit trust in Kenya with a market share of more than 30%.
They're called
CIC. Oh, CIC. That's a household name. Most of us know it. But that's like Sanlam. If you just go at the threads that I do, or maybe the links that I share, you'll find links that I share. You can sign up. So you just sign up like a normal account opening forum, whereby you just put in your details, your KYC details, you upload your documents, and then maybe after 1 working day, you'll get an email where your account is ready. Then you can start funding your account.
So you need CIC bank?
That's CIC Asset Management and under CIC Group. Then we have Sanlam, we have others like Kuza. Even nowadays, most banks are entering into asset management, so they also have money market funds. But maybe they aren't as big as what asset management companies are doing.
So that's the Nini, because I think even one of those things you said was very interesting, where you're saying like their returns were between 18 to 21%.
No, between 12 to 16%.
Or 12 to 16%. Because let's do like some basic mathematics, like very quick. Right now, if you were to guess, how much is a 3-bedroom apartment in Langata?
3-bedroom?
Yeah.
In Langata?
Yes.
Apartment?
Yeah.
Buying?
If you're buying cash?
I would say...
You have to make a wild guess.
20M?
20M. Sindio? So, let's look at it this way. I used to live in an apartment near Langata. And it was a 3-bedroom. And I used to pay 30,000 as my rent. So 30,000, if I take this 30,000 times 12, that's 360,000.
That times 12. Yeah.
Yes, 360,000. 360,000, if I'm to then divide it by 20 million, if this person bought this for 20 million, you see now we are talking about, is it 1.8%?
Maybe you could have used 500,000.
Yes.
Yeah. 20 million, that's...
Yes. If it's 500,000, 500, okay, wacha tuanze na hiyo. Okay. So 20 million, 500,000, yes?
Yeah.
That's 2.5%, ama?
2.5%.
Yeah. Yeah? So that means the whole year, mtu, hii pesa yake iko locked na anatengeza 2.5%. unless nimefanya calculation wrongly ama
maybe we can
okay wacha tuifanye like tutoe 03 tutoe hizi 03 tutoe 03 si ndio so tulikuwa na 500 so tumebaki na 500 over 20000 si ndio then tutoe hizi 02 tutoe 02 tunabaki na 5 over 200 which is 2.5%.
Yeah.
So unaona when you tell this person that this house is not a good investment, the fact that you're going to rent it out and don't forget rent is never guaranteed. The tenant can end up in problems and pesa yako imepotea.
Okay, so if you look at the real estate market in Kenya, I think one of the main reasons I've been trying to say it's overhyped, so maybe it's not a good investment, is one, it's in terms of the returns.
Yeah.
Because I think we even had a Twitter space sometimes late last year with some real estate experts. One was Tim Kipchumba, the other one was Nahash Nokawa, who are very trusted real estate experts in the country. And one thing that we all agreed on, or maybe one of my pointers that why real estate is overpriced, is that you can hardly get a real estate project giving you north of more than 10% in returns. Even 8% it's a lot. Most real estate projects will give you between 6 to 8%. Yeah, and if you look at the other asset classes that we have in the market, even a money market fund that is giving you 12%, T-bonds are giving you 18-19%, and then stocks maybe in the long run can give you even higher returns than that. Yeah. So, okay, yes, they always say that there's also the aspect of capital appreciation. Also, you attach the capital appreciation with the rental income. Because if your house, maybe if you bought the house today at 20 million, maybe in the next 5 years the house will be worth maybe 25 million. So maybe there's that aspect of capital appreciation.
But who will you sell it
added with the rental returns? But what,
because if there's a ready market for the house, maybe because pia kuuza hao ni ngumu.
And also that's theoretical, because you always assume that maybe the time you are selling, that maybe that house will be worth more than it's worth right now. But if you have, I'm not sure I think I've seen a report here by land prices or even house prices have gone down. So it happens, especially. It can happen. So there's also that factor. And also the other thing about real estate, by the way, and land, is that most people don't buy these houses cash. They take bank loans to finance real estate projects. And
the bank loans uko ni 20-25%.
Now you can imagine
ridiculous rates.
Now you imagine, let's take a case of you, maybe you have 10 million cash right now. You are looking at the investment options that you may have. So you may find maybe someone saying, okay, I have 10 million right now, maybe I can build some real estate property maybe worth 20M that maybe I can, that's your understanding, that's your knowledge, that's your level of financial literacy. The only thing you're eyeing on is real estate. So you have not considered the investment options. So you'll end up taking an extra 10 million loan, and at very crazy rates. Unless it's maybe from a circle that maybe has maybe lower rates, or even 12%, it's still high, assuming because the returns from real estate may not surpass that 12%. So you can see yourself now, you'll find, okay, I think I've even shared cases of this where clients come and tell me, okay, it's not that I'm struggling financially, but I brought these problems to myself by maybe taking on a real estate project that I never had the cash to finance, so I had to go to the bank for a loan. And now you are living comfortably, but now you bring discomfort in your life, because now you have to meet, yes, you have a real estate property, and now you have to look at yes, you have already even finished it, but now you have to look at the occupancy rates. So if you look at most real estate projects, the occupancy rates, okay, there are some with 100%, but 100% it's very hard. It's not normal. Most are at 60, maybe 70%. Also, maybe depending on location.
I think the ones that are 100% are where the rates are below the market rate. You understand, like the rent is not super expensive.
And also Pia, there's also a factor of brand. There are some real estate developers who have got very good names out here. So whenever they put up a project, they always get clients fast enough, even before maybe they have even finished the developing stage. But what I was just trying to say is, if you look at the returns, okay, I was talking about the point whereby this client is bringing some discomfort to his life, because now you have extra headaches now. You have the bank loan that's struggling, you're struggling to pay, and now the bank loan depends on the occupancy or maybe the rental income you're getting from this real estate project. But now there are no clients. And also some clients don't pay on time. And also there are some repairs and maintenances that we'll have to do. Okay, some will say that some repairs clients will pay, but okay, what about the sewage that blocks? Who will pay for that? Who will pay for that? maybe security and all those other expenses that come with it. So I think for me, okay, we always say personal finance is very personal, but for me, I've always found real estate to have a lot of headaches for me. Well, even if you can, yes, you can outsource the headaches.
Yeah.
But okay, why then go for the low returns? Yeah.
Because Sunday it's interesting. Sunday nilikuwa naenda home na a distant cousin of mine. Na akacheki kwetu unajua sasa Kabete is now opening up. Sasa ni kama ni decongestion plan ya Nairobi County. So napata wase wengi wanajenga these flats na nini. Wale wase wako na shamba zao. So napata for them to kujenga kitu ina attract, guys living middle class, tuseme middle class. Una spend around 100 to 150 million on a flat. And then average rent your area for a 2-bedroom it's like 30k. So say ile do ataka how long do you anze kurudisha?
Yeah, it's ridiculous.
All this money. Yeah.
It's
so kuna hiyo fascination
but I think maybe ataangalia hiyo kani 30,000 volume, like how many flats does he have up?
No, sana pata like I don't know 15 20.
Yeah, so maybe ataangalia hivyo because kani let's say it's 15, that's 450k. Alafu maybe anaangalia in 1 year that's 9M. Yeah, so nachukua 20 years amerudisha do. At least now
so niko like unless sasa anaingia hapo tuseme if kama naingia kwa project kama hiyo si yangu, I'll never enjoy the returns. Maybe my kids.
Yeah, actually most people say that real estate is a long-term project, it's a long-term game. That's when maybe you'll see the real returns. And so they also say that it's the best form of passing on wealth maybe to your kids, maybe to the next generation. Because real estate it's a 30 years project.
Yeah.
So, so it makes sense in a long-term perspective, maybe in a long-term view. But for the average person, if you are looking maybe to build your wealth, also if you are focused on returns, I don't think real estate is the place to be. There are so many asset classes that can give you better returns and lower stress levels than even that real estate. Because now you can imagine now you have to deal with clients who are late to parent, you have to deal with repairs, you have to deal with a lot of things. But now if you just bought maybe a government bond, yes, guys are saying that the government has a likelihood of default more so recently, but bonds have been relatively low risk from many years back. Because our government of Kenya has never defaulted. It's not like governments of other countries who are known for defaults like Argentina and other countries. But yes, times change, but I still think there's a lot you can do with other asset classes than real estate for the average person who is looking for returns, and also who is looking for an easy, not actually an easy way, but a better way of building wealth.
Okay, so Nini, I think before we continue, because I want us to talk about treasury bonds and treasury bills and if there are any differences. What would happen if the government was to default? Indio swali niliulizaga Willis Otieno, but him is a lawyer, so he gave me his version of it. Apart from him being a lawyer, of course, he's also part of the opposition. Ni Safina Party. So na Jimmy Wanjigi, of course, they have to cane the government.
Leader is Jimmy.
Yes. Yeah. But what would happen if Semeleo Kenya may default? What happens?
Yeah, actually, I think there's a thread that I did. I think it was sometimes last year, maybe late last year, because I was getting a lot of concerns from clients, maybe from guys in my communities and followers who were asking me, okay, is the government likely to default? And if they default, what happens? Yeah, so basically, a default, what default means is that it's when a government is unable to meet the payment of a coupon. Yeah, so maybe there's a coupon that's supposed to be paid during a certain period of time, but the government doesn't have enough money to pay for that coupon. So it means that the government has defaulted. So after default, there are a lot of things that can happen. There's restructuring, there are haircuts, there are a lot of things that can happen to mitigate the situation, maybe to come to a there are a couple of ways you can go about the default. But now from an investor's point of view, if the Kenyan government was to default, I think there would be a lot of chaos in the financial markets, because if you look at our banks and their assets and the proportion of T-bonds, or what you call maybe government securities in their assets, it's quite high in most banks.
Oh, okay.
Yeah, some have even highs of maybe 30%. And also now you can also see that these asset managers like maybe, or these fund managers like what you have money market funds, most of the allocations also in treasury bonds and treasury bills. Yeah, so the financial space, or maybe the financial industry, it's huge on government securities, because even pension schemes and retirees money, it's hugely invested in government bonds. Yeah, so a default will bring a lot of ripple effects to the economy, almost to the financial space. And also now, once you default, your credit rating as a country goes down. So it will be very difficult for the Kenyan government to get financing.
More loans.
Yeah, to get more loans, whether locally or maybe even externally. Okay, the main pressure point, or maybe the main point, is the Eurobond that's maturing this year. Yeah, which the government has been going in all sorts of ways, trying to say that they are buying back, they are trying to make earlier payments, but you have seen all sorts of things happening. But yeah, with the IMF and World Bank coming in and promising to back up the Kenyan government, I think we'll sail through. But okay, nothing is guaranteed, of course, but I think we are at a better place.
Oh, okay. And this better place here, death. Okay. Oh, okay. Yeah, because but so this haircut thing is real, where like if you are to default, utakuwa ukiingia kwa bank account yako, ulikuwa umeka 10,000 unapata 7,000. Okay. 3K imechukuliwa na gava.
I'm not sure. Okay, what a haircut. I'm not sure about the ripple effects that it will have down to the
average Kenyan.
To the average Kenyan. But basically, a haircut is where maybe the restructure, or maybe how the government can deal with this is that they will come in an arrangement with investors who have lent the money, who they have borrowed money from, and they'll say that, okay, yes, we owe you this money, but maybe we'll make this payment at a later date. Maybe you are supposed to get back your money maybe in this year, maybe in June, but they'll say that, okay, maybe because the financial challenges that we have, we are going to pay you that money in 2025, 26, 2027. And then maybe they can also that, okay, yes, you are lending us the money at maybe 12%, but now we are going to give you at maybe 5%. Yeah, and also maybe they can say that we have foregone maybe 30% of the loan that you had lent us. So if you are a big investor who had loaned money to the government at maybe 10 million, then they're going to say that, okay, you're going to get 30% off, so we only owe you 70. We are only going to pay back 70% of that. Yeah.
The rest
is
apa IKONINI susamanga, you can go collect it in a place called Kajitombe. Oh, damn. Okay.
Yeah, it's better for you to get 70% than get 0%.
Than zero.
Yeah.
Yes.
So they're just trying to narrow down, or maybe to reduce the effects. Yeah.
So okay. So tumeongea money market funds. Treasury bonds. If I want to invest in treasury bonds today, what do I do?
Yeah, I think it's quite easy nowadays because of the recent developments in the recent developments by CBK. So recently, I think it was late last year, CBK launched the CSD platform. Yeah, which makes the account opening of a CDS account very easy. So a CDS account is what you use to invest in T-bills and T-bonds. So before the CSD was launched late last year, I think it was in September last year, if you wanted a CDS account to invest in bonds and bills, you had to physically walk in a bank. CBK offices.
For CBK?
Yeah.
Oh, yeah.
And to open an account. And account opening used to take quite long, 14 days. Some clients will even take a month before they got their CDS accounts in check. But now with the app, you just need to log in, your account, your KYC details within, I think, 24, 48 hours, you have your account.
Okay.
And then now just the bidding process, which is very easy and straightforward. Okay, maybe for the normal person or maybe for the average person, it's not straightforward. But I think right now there are a lot of resources about that. I keep on doing the threads on that. There are even guys who have YouTube channels doing, guiding people on the processes, articles. I think it's quite easy after you have opened your CDS account. But what you just need to understand is that the minimum investment is 50,000 for T-bonds, 100K for T-bills. Yeah, then the bidding process, you're also bidding on the app. You can either bid competitively or non-competitively. We usually advise clients to bid non-competitively.
What's bidding?
Bidding is now, the bills and bonds are auctioned by CBK. So you have to bid for... Bidding is now the process of buying now. Before you buy, you have to bid. Then your bid must be accepted so that now you can make the payment from your bank account to the CBK account. Yeah.
Okay. So kishazibai unazishikilia?
Yeah, so bonds have maturity dates. So you can T-bills are the shorter term securities. You have the 91 day, the 364 day, and the 91 day. We have the 182 and the 364 day T-bills. So these are the short term securities. Now T-bonds you can have maybe from 1 year to 30 years. Yeah, so depending on the maturity date of your bond, you have the most recommended strategy for retail investors is buy and hold. Yeah, because the secondary market isn't always an easy walk. For most retail investors. Yeah.
Oh, okay. So maturity date ikifika, I have to take the money. I can let it compound.
Okay, so maybe something that maybe I forgot, maybe something that I'm assuming it's straightforward is that how you make money by investing in T-bonds. Okay, T-bills are the short term, so T-bills are discounted. So maybe you want to invest maybe 100k in a T-bill.
Yeah.
So you'll pay a discounted price of let's say 95,000, maybe 96,000, and then at the maturity of that T-bill, you'll get your 100,000 back. So that's how you make money in a T-bill.
Okay, so you make this 5k.
Yeah, that's the discount because it's something short term. Yeah, but not for T-bonds. You have to. They are long term. Yeah, so there are coupon payments that are paid. So coupon payments is monthly. Monthly, it's the semi-annual interest payments, not monthly, but semi-annual interest payments. So that means if you invest 100k in a T-bond, that maybe 16%, that will be 16,000 per annum. Okay, let's assume it was an IFP, so let's not deduct the withholding tax of 15%. So 16,000 will get to in two semi-annual interest payments of 8,000 after every 6 months.
And then you can take your 100.
Now you will take your 100 after the maturity date. So if you had bought maybe a bond that was maturing in the next 5 years, you'll keep getting your interest payments, or maybe your coupons every year, twice a year, until the final year you'll get your money back.
So okay, this is interesting. So let's say I invest 100,000 in T-bonds.
Yeah.
Na nini ya 16%. Yes? Yeah. So I'll get this let's say 16k till the maturity date.
Yeah,
so every year the 16k.
Yeah, but we have not accounted for tax there. There's a 15% withholding tax, but FBs are tax free.
See, the 15% is from the 16K.
Interest. Yeah, from the 16k.
Okay, so
that will come. Okay,
let's even push it on the higher side. Let's say it's 25%. So that means I'm making 12k. So this 12k, if the maturity date is 5 years, I'll have made 60k before I get back my 100.
Yeah.
Okay, and I can still decide not to withdraw the 100 to just stay there. Now after maturity I have to take it back and then
after maturity there are a few options that you can do. So you can either get your money back, or maybe you can use the money to buy another bond.
Okay. But you can't just continue like
it's not automatic. When you are bidding for the bond, maybe when you are making the applications, you can either decide what to do with when you get your money back. Are you going to use it to invest in another bond, or do you want it deposited in your just bank account?
Okay, alafu there is a difference in the money market fund. In that, with the money market fund I can just get my money out at any time.
Yeah.
T-bonds I can't.
T-bonds, okay, for T-bonds it's not straightforward, but you can, you can't. The liquidity is how fast you can access your money. Liquidity for money market funds is quite high compared to T-bonds, but they're still liquid in the fact that you can sell your bond in the secondary market. So let's say you invested your 10M this year, and maybe you bought a 5-year bond. Maybe at the second year you get a financial emergency, or maybe you get a project that you urgently need your cash back. You can sell your bonds in the secondary market and get your money back.
Okay.
Yeah, but not selling in the secondary market. Now you can also, obviously, in some cases will make a small loss because now it's a market that's being determined by buyers and sellers. So depending on how yields on the past and current bonds are performing, you can either sell at a higher, maybe at a lower price.
Okay. So then the other question would be like, if we come as Steve saizi, you have a 2 million shillings that you want to invest. Na 2 million, you're 100% sure even if you have a financial emergency, you'll never want to use this 2 million. What would you invest in? A money market fund, treasury bonds, or treasury bills?
I think I've always get those questions where people are asking, which is the best avenues to invest in. But I think you can't really take the question out of the financial situation of the person.
Okay.
So you have to take you as Mwafrika and say, okay, this is who I am. Okay, this is my level of wealth. These are my financial goals. So this is my age. This is my risk appetite. These are my financial goals. You have to take account those things that are attached to you, that are personal to you, and then bring them in the equation.
Okay.
Let's say that's how it will affect different people.
Someone with a low risk appetite. That means I'm trying to make a safe nini. Staki kitu itanipatia heart attack. Like, nimeamuka. Nilikuwa nimeinvest. What were they saying? Were they saying that like people who invested in Nation Media Group at 1 million I think how many years ago saizi the 1 million is 40k. I had something like that.
That's something that I've seen in the financial industry, and we regard, maybe I can just point it out here, but I don't like such comparisons because we call that financial porn.
Oh, okay.
Financial porn.
Yeah, what Ian loves. Okay.
So what financial porn?
I'm a porn addict.
What financial porn is? We'll see guys doing maths like, okay, if you had invested, maybe when Safaricom was doing well, maybe right now the hottest asset, maybe it's Bitcoin. So we'll see guys saying that, okay, if you had maybe bought Bitcoin at this amount, you'll have made this kind of money. But what you forget is that there have been challenges during that process, maybe in the last 5 years. Okay, maybe I can give a better example. It's maybe one of the best used example is maybe a company like Apple. So people who say that, okay, maybe if you had bought Apple maybe 10 years ago, you'll have made this amount of money. So you are trying to make the investment sound fancy or maybe good, but
They're in between.
There have been a lot of challenges, a lot of panics. There are a lot of people who have sold. It will have taken a lot of courage, a lot of
guts.
a lot of guts to hold that investment for that period of time. So whenever we're talking about NMG, which is maybe probably one of the worst performing stocks, also talk about the best performing stock. Like just give a standard comparison. Just don't be one-sided. That's what we call now financial porn, which is not good, and it's very very prevalent in the Kenyan markets when people are doing analysis of stocks or maybe comparing one asset to the other.
Okay. Alafu najua there are people who will see the irony in what you said. I don't know if it's the irony ama vile umesema that when you're talking about like bad stocks kama the Nation Media Group, you have to give a standard comparison.
We put all groups together.
But I think it's all like traditional media, especially that rely on gazeti. They've been struggling because of how much technology has changed. I think I had this with Jemo ule msee alisema every time you're reading a newspaper, you're reading yesterday's news. And I remember when he said that, I was like, yeah. You know, back in the days, this was actually news. You'd read a newspaper and you'd be like, this is news. But actually, right now, you're reading yesterday's news. People have moved on. Like, so kuza gazeti inakuwa like, apart from think pieces, like why are we not buying newspapers, you know?
Actually, there's a guy called Balaji's who was the former CTO at Coinbase, which is a crypto exchange firm. I think it was in around 2020 where he was making the predictions that we are moving from the standard or maybe from the conventional media houses to whereby we'll have individual media houses. If you look at guys like Joe Rogan, guys like even here in Kenya, guys like Abel Mutua, there are some brands who will be bigger than media companies. And now with the ability of maybe platforms like social media and YouTube, anyone with a mic and a camera can start doing their own things. You can become your own reporter. And still deliver better news, quality news than what maybe a media house can do in some angles. So if you look at the rise of platforms like Substack, newsletters, you can see a lot of people are becoming creators. So that's how you'll see more people maybe moving from the traditional media industry now to the digital world. So I think he made a very good prediction which is coming into play.
Because like one of the saddest things that I feel, because I used to work in easy mainstream media, but right now apart from the old presenters I don't know anyone. Like I know mi najua Jen Ngoiri, najua Rashid Abdalla, najua Lulu Hassan, but if you are employed by Nation last year sikujui na si ati nakukosea heshima, I just don't know you because I get my news on Twitter.
You don't even know how to tune. I can't tune into you like it's like a whole different Nini, like you have to push some buttons, save whatever.
Like news yangu kitambo nilikuwa namkaga so wewe nasikia this is 7 o'clock news, this with Laura Walubengo. I don't know the Laura Walubengo of nowadays. Like who is he or she? Simjui. And that's how much the world is changing so much that now maybe these media stations nakaka the usikiaga story of the Polaroid camera where I don't know how true the story is, but they were offered a certain amount of money and they said GICHUKI. Then a few years later digital phones started taking photos na stock ya Polaroid ikatoka from hapa too, because remember it used to be the best technology because I could take an instant photo na ni print. So technology is harsh.
The point that Balaji was talking about, decentralized media, decentralized finance, we're moving to the decentralized era. You can see even Bitcoin and the blockchain technology. everything it's becoming decentralized nowadays.
Yeah,
So even media houses are becoming decentralized. We are not relying on one media house to give us information. The centralized media house or maybe the mainstream media houses. We can rely on different guys and still take that information as okay. We might negotiate. Maybe we might argue about the truth, or maybe the what do you call it? Maybe they're not a trusted media house, but with time you can be able to build trust. With a bigger following and bigger audiences, can be able to build trust.
Okay, and then you also talked about circles. By the day we are recording, I think the previous day, there's someone who'd written about a circle, and you'd corrected them. Most students who are Americs wanajuaga, one of the things he teaches people is join a circle. So how important is it to join a circle?
Okay, I think the biggest advantage of a circle is the ability to access. Okay, I'm not going to call it cheap credit, but maybe I can say affordable credit.
Okay.
Maybe affordable loans, because if you look at what loans are, what rates banks are lending money to individuals and to businesses right now, after the CBK raised the CBR rate, I think it was it late last year? Yeah, late last year. Yeah, most guys have gotten the messages from their banks telling them, okay, your loan facility, which was at 17% per annum, has been increased or has been revised to 19.5%. There are some banks with high loans at rates at maybe 23%, 25%. But your circle most circles are still at 12%. Yeah, so that opportunity to get an affordable, maybe to have an alternative source of credit, I think it's the biggest advantage in a circle.
Okay.
But there are also other advantages because the saving your money in a circle. So there are two ways you can make money in a circle. One is through share capital, then the other one is through the savings. So share capital is the number of you buy shares to become a member of a circle. So let's say we have Mafrika circle. Yeah. So to be, let's say, under our rules and regulations, we have that for you to be a member of Mafrika circle, you have to have bought 1,000 shares. And each share is maybe 200 shillings. So the minimum share capital is 200,000. Yeah, so that's the share capital. Now the share capital, you get returns via dividends which are annual. Then savings also, for most circles, the contributions are compulsory. So you must make a certain amount per month. But circles nowadays are shifting from that, and their contributions are voluntary. That means you are on your own. If you feel like making contributions, you can make them. If you don't feel like it, you are on your own. But now on your deposits, you get what we call rebates, maybe what you call interest rates on your deposits.
Okay.
Yeah.
Oh, and so then Nini, I think there's something that I'd skipped. There's something I saw that you'd written, like when someone invests in treasury bonds, there's something you called bond laddering. Yes, and I found it to be super interesting. But can you explain it to maybe mtu ajaisikia juu ya bond laddering? Tuseme, I think you'd use the example of 1 million shillings. You want to invest 1 million shillings. Yes. Okay,
so bond ladder is a very useful strategy to invest in T-bonds, maybe to grow your bond portfolio.
Okay.
And how it works is that it works this way. So let's say you have, okay, I'm trying to use numbers that will be easy to work with and that makes sense.
Yeah.
Okay, so let's just work with $1 million. So let's say you want to invest $1 million right now in bonds. So instead of investing that 1 million in one single bond, you divide your 1 million into maybe a series of 5 bonds. So that's you have 200k per bond.
Yeah.
Right. So what you're trying to do with bond laddering is that you're trying to build a ladder with a series of bonds. So you're trying to stagger bond maturities and also the interest rates, because different bonds have different yields and different bonds have different maturity dates. So I think you have seen recent, okay, I'm not sure if you guys are familiar with this, maybe you're not following the markets keenly like I do, but recently when the yields from government bonds have hit 18%, 17%, guys who had bought treasury bonds maybe last year, which were fetching maybe 12.5%, 13%, are rushing to the secondary market to dispose their poorly performing or maybe low yielding bonds, because now bonds are fetching high returns. Because okay, why will you hold your 10M that's giving you 12.5% for 10 years while you can get a facility giving you 19%, 18% for the next 9 years? So it makes sense. But now the disadvantage is that you'll have to sell maybe a bond at a loss in the secondary market, because no one wants to buy a low yielding bond. So the price is very, very chaotic or very pathetic. So a bond ladder is where you distribute your bonds maybe in a series of bonds, like we said, 5 bonds. So you have maybe one bond maturing 1 year from maybe 2 years from now, another bond maturing maybe 3 years from now, another one 4 years, 5 years, depending. You can stagger them anyway, but just have to they must have different maturity dates. So you can try to achieve different things with the bond ladder, where one is getting a monthly interest payment every month, because you said bonds you are paid 2 times a year or semi-annual payments. So if you have 6 bonds, that's 6 times 2, you get 12 monthly payments. You know, the good thing in CBK is that in their prospectus they'll tell you, okay, this bond coupons will be paid on maybe July, maybe Feb, and maybe 2 plus 6, that's August. So Feb and August of every year. So you can get different bonds that are paying an interest, maybe a coupon at every month of the year. So with that you can easily build a portfolio that gives you passive income every month. Another other thing that's good with building a bond ladder is that you can also reduce the chances of something like, you know, the fluctuation of bond yields that has happened. So now instead of being locked in the 12% yield that we talked about, maybe that was bonds affecting last year, you still have money to invest in bonds that are being floated nowadays when the yields are high. So in your portfolio you'll have a mix of both, which is very good because you have spread your risk. So for you are comfortable because, you know, if the yields rise, you can still invest more money because you're building a ladder.
Na ulisema right now, like, it's so simple. I just naenda kwa hiyo nini na open a CDS. It's not like a long process.
It's not a long process.
So it's, if I was to Google CDS,
it's CBK. So you can just go to the CBK website. You'll find DAO CSD. Maybe you can just Google DAO CSD. It's on the CBK website. You just open there. You fill in your details. You open your account. Then maybe within 24-48 hours you'll get your account ready. Now the only challenge for you to build a bond ladder right now may be the number of bonds being issued by CBK. Because I think right now we only have 2 bonds in the that have been floated by CBK, and also the maturity dates, because you know you are looking at different bonds, different maturity dates, and also different payments, monthly payments for the coupons. So there are those factors that you're trying to look at, but with that also you can also chip into the secondary market and get bonds that have been issued in the past that maybe meet the requirements that you want. So maybe if you want a 4-year bond that's not in the market, maybe you can go in the secondary market, maybe you'll find one. And going in the secondary market, make sure you use a stockbroker or an asset management company because they are most affordable. Because banks are very
you sasa now we go back to zilikuwa tunaongea kina CIC. CIC ni money market peke yake.
Maybe they will bring, CIC isn't yet offering the option to invest in T-bonds, but there are other asset management companies like Kuza that can give you the option to buy bonds in the secondary market, but also stockbrokers like Faida Investment Bank, BXS Africa. Also give you the option to access the secondary market.
And is it still as safe as dealing with CBK directly?
The only difference is that there's a small charge that they'll charge you. That's like, the only difference. The service fee, because they're coming in there to provide the service for you.
But it's not like a ridiculous 5% or...
No. It's actually quite low. I think it's even less than 1%. That's for stockbrokers. But for banks, they charge what you call entrance and exit fees. So if you're buying a T-bond, they will charge you the entrance fee or maybe the access fee for that bond.
So according to you, there's no reason to buy T-bonds and what through a bank. Just use
maybe some. I've not tried all banks, but mostly from my experience and from what I've seen, it's not advisable. So you have to, the average person doesn't know the details or maybe the differences of the alternatives. But if you know how it works and you go through the details and the transaction, the what do you call them, the costs that are involved, and you are sure that comparing to going through CBK or maybe going through a stockbroker, that you have a good deal, then you can still go for it. I'm not sure about all banks, but most banks that I've seen charge very ridiculous costs.
Because it's so interesting looking at hizo rates. Like if someone was to kujipanga vizuri. And then you talked about, so spacing, that's dependent on CBK,
spacing, no, you can also control that, because now the spacing, now you can have a 2-year bond, a 3-year bond, a 4-year bond, a 5-year bond. But what I said is, if you want to have maybe a perfect or maybe a good bond ladder, you have to access the secondary market, because that's where you can get different bonds, many bonds, because CBK only floats bonds monthly, and they will float like 2 bonds per month, and maybe those bonds that will float this month they don't have the qualities that you're looking for. But okay, we are talking about someone who has maybe the 1 million to invest right now. But if it's something that you want to build over time, maybe the next 2-3 years, I think there's time. Within 3 years, I think you can get the good bonds that you're looking for.
Oh, okay.
Yeah,
okay.
With time, you can
in
get
the meantime, you can invest in this.
Yeah, then
and every
wait.
time there's an opportunity, invest in another Evo.
Yeah.
And then before you know it, you've spaced them.
Yeah, you've spaced them well,
yeah. Allow sasa you can just, you have your liquid to some degree.
And also still getting your assets are generating cash.
Okay.
Like the guy who bought land in Kamulu, who's just sitting with them
waiting for the road to be constructed.
Hapa
njia ikifika hapa
and as Jared passed through.
Then another thing I also saw you talking about is people can invest in the Nairobi Stock Exchange. Me, the closest I've ever come to investing in Nairobi Stock Exchange was working at Nation Media Group. Otherwise, I always look at it like, hii ni kitu ya iko na wenyewe. Are there easy ways, like to just go online and invest in the stock exchange, no?